Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to take a look at market action this morning, Phil. And it seems as if we're factoring in the civil unrest, record COVID-19 cases and death. It looks like the market might be coming to grips with this after hitting all-time highs.
Well, the market's taking a little breather, but really last week was a pretty positive week considering all the things you just mentioned, which would normally be kind of negative for markets. I mean, we ended at the end of the week back at new all-time highs. So the fact that we're having a little breather is probably just a good thing for the market to take a breath and look at all the things you just mentioned, the COVID cases, the vaccine rollout's going a bit slower than expected, and what is going to happen politically in DC in the next couple of weeks.
Phil, let's take a look at an update with the COVID-19 data. We have a number of charts here, and as you had mentioned, it seems as if we are peaking, but there's a number of data that we need to work through here.
Yeah, I mean, if we look at what happened in Europe, who did pretty aggressive shutdowns, once again, those aggressive shutdowns really helped. So they almost cut their new cases in half. In the US, we've kind of had a half-hearted sort of attempt at shutdowns. That's one of the reasons why our economy has been stronger than Europe. But at the same time, it means we've got a lot more new cases still coming through the system. We haven't got the exponential growth, which is kind of what you're talking about, but we're still seeing growth after we've come back from all of the holidays. So potentially there was definitely a sort of slowdown in testing during the Christmas to New Year's break. And some of the new cases might be just a rebound from that. We sort of hope so, because as the vaccines roll out, we can see the vaccines now are being injected faster than new cases are coming through, but only just.
And let's take a look at some of the employment numbers. We got, of course, the non-farm payrolls out on Friday, seeing a decline for the first time since April.
Yeah, that's yet another data point that the market seemed to overlook last week, isn't it? I mean, the data was expected to be weak, but it actually came through with a decline in employment. So you can see the red line of this recession. It hasn't even got back to the worst levels of the credit crisis, which was the worst recession in the last few decades. So that kind of highlights just how many people are unemployed. And the fact that we've had this downturn is because of all the spike in new cases, restaurants being closed down, retail being closed down, especially in states like California, which has hospitals pretty close to capacity. It was kind of expected, but it does show what a long way we've got to go to get everyone back to completely normal. If you look at the sort of breakdown of who lost their jobs, it was a lot of leisure and hospitality, which is probably expected. Retail actually did okay, but then again, we've just had the holiday season with a lot of people shopping for holiday gifts. So it's not the greatest employment story, and that's one reason why we keep looking back at the new coronavirus cases, because retail could see a reduction in January just because we're past the holidays. If the hotels and the airlines and all of the leisure and hospitality industry is still being hurt, then it's pretty difficult to get the unemployment numbers to come straight back.
Phil, I also think part of the challenge of it is too that all this data is a month or two or a few weeks behind what's actually happening right now.
Yeah, and I guess that is one of the problems that we've had economically, is a lot of the really strong, the sort of believable data is 3 weeks, 4 weeks in arrears, and yet we're seeing daily the new coronavirus cases. But having said that, a lot of the data that's come out with people looking at all of the daily data and coronavirus cases has surprised to the upside. It hasn't been as bad as we thought. Pretty much the whole way through the recovery. And that's one of the reasons why the market has been so strong, is everyone's looking at coronavirus cases and thinking things are going to be very dire in the harder data. And in reality, we've had kind of a V-shaped recovery in employment up until the last couple of months. And we've had a really strong rebound in manufacturing and factories and the goods sector. And so there's a lot of things that have been more positive or less negative than people thought. So that's kind of been the reality of the data, actually. It's been net not as bad as people thought when we actually see it, considering coronavirus makes it look really bad.
All right, Phil, good stuff. We'll talk to you on Wednesday. Thanks for joining us, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.